Good morning, Bay Area. This is John Payne with the RateWatch Now Daily Update Report. Got a lot of news to go over, so let's go ahead and get started. Snapshot of the mortgage-backed securities market yesterday. Pretty much gave back all the profits that we had gained the day before. What's going to make rates go up today? GDP is out and is up 1.7%, or rather, it's up to 1.7% from 1.6%. Now, this really should not cause the markets to rally the way it's doing because, let's just look at the facts. Reliable growth is 2.5 to 3%, which will help offset inflation. Growth to create jobs is 7.5%. So I don't see why this is really causing a rally in the market. And I think that, any news, any good news, I guess, is great news in the recession, but this is not enough to do the job that we need. Jobless claims, same thing. We're still way too many people unemployed. Although the jobless claim number looks better, we still have a long way to go. And I'll show you that in a minute. Chicago PMI, that was an eye-opener. That was quite a bit of information, but there's another story to that as well, and I'll get to in a minute. The Fed came out and made comments about he stands firmly that the Fed should not intervene anymore in the economy, and that includes of buying assets. That was a market killer yesterday. Just as numbers were starting to go up, he comes out and speaks, and they go back down the other way. What's going to make rates go down today? $68 billion Ireland bank problem. Now, this is the worst case scenario, but is going to cause a flight to quality back over to U.S. bonds. Spain was downgraded. I mentioned that yesterday, that they had a problem, and now they have been downgraded. PMI, the back order log. This is the back picture for the Chicago PMI. Now, the back order index is shrinking, and what will wind up happening is that we will wind up seeing that the PMI issue next month will decline from where it was this month because the back order has shrunk. So, good, not so good. 7-year auction went well yesterday. 7-year auction was going great until this guy spoke. So, go figure. This is a snapshot of the GDP, and this is what I was talking about. I drew a line at the 2%. That is about where we are now, and it should be a little bit lower. It's a little bit higher. It's a little bit higher than it ought to be, but go ahead. I'll give you 2%. That's where we are right now. And if you look here, these are the areas of recession where we were below the line. We need to be way up here to create jobs. So you can see from here to here, we have a long way to go. Also, unemployment, recessionary periods. You can see that we're right where we were, right in the middle of the recession of 2007. We have a long way to go in order to say that we are no longer in this unemployment crunch that we're in. So although the numbers are better, they should not be a case for the rally that we're seeing this morning. And hence, I think by the end of the day, tomorrow, you will see a huge bounce back. So for all of my LOs out there, float today. I guarantee you, float today. This is how the market has responded so far to the news. I actually got an update while I was creating this, and now this line is about right up there, 102.7. So you can see, as I was saying, we're starting to get back a little bit of what we gave up this morning. This is how the lenders so far have responded to the news that I just put out. And again, I'm expecting this to change. Here's where we are. Good snapshot. I widened the range because you remember in the beginning of the week, I said that we will probably experience a 100 basis point swing throughout the week with this news. So I do believe that we're still in a good range, a good, healthy, safe range. We did come below the trend line. Right now, we actually got way down here, and now we're back up. So we did get pretty much below, but I do believe we're going to bounce back up above this trend line again, either later on in the afternoon or tomorrow. Here's a longer view of the same picture. In summary, we have three distinct things that have exaggerated trading, which was the GDP and the jobless claims and the Fed speak. Volatility is expected in this market, and as I said, we would experience 100 point swings, and we have. Um, Poster's comment started the whole problem yesterday, and it just takes that kind of news, fundamental news, to just sway the markets. GDP is still too weak, jobless claims still too high, and we are and should remain within the broader trading range, and the Dow is overbought in my opinion. And I look for a bounce back later today or tomorrow. That's all I have for you today, Bay Area. I know it was a little long, so please excuse me, a lot of information. If you know of anyone that could benefit from my morning update, please play it forward. Until tomorrow, Bay Area.